Hey everyone, me Kevin here. Oh man, we had a jobs report come out this morning that at first looked like it kind of matched what economist surveys were, but the more we looked at the details, the more we realized, buckle up, because the Fed is about to whack us back into the hole. They are not going to be happy with this report. In fact, markets are now pricing in a terminal Fed funds rate that's slightly higher than yesterday at about 4.66%, but those on Wall Street say the market still hasn't priced in enough. And that's why the market's probably turning red, because now we're getting folks on Wall Street saying this report could potentially be what finally pushes the Fed from a terminal, that is a high Fed funds rate of 4.6% to 5%. That means the next FOMC meeting in November is almost certainly going to have a 75 basis point hike, and unfortunately, it is unlikely that we're actually going to see a substantial softening in the Consumer Price Index report next week, as we still have hot labor data, which unfortunately is driven most by leisure and hospitality. And I hate to say it, but I'm in a hotel because I'm about to go on a weekend trip with my family, and I'll tell you, the biggest increases were in entertainment, food, and dining and drinking establishments, and let's just say I'm contributing to that inflation. So up front, I'm sorry. Now, in the long term, JP Morgan believes that in order for us to actually get inflation to go down to 2%, we are going to have to see the unemployment level, or I should say the jobs level of inflation, sit around an annual 3% rate. Presently, that rate, and in this last report, it is at 5%. So we still have a while to go before we actually see wage inflation start declining. Month over month, we're sitting at 0.3%, which is right along expectations, but still at 3.6% annualized, which is also still above that 3% that JP Morgan believes we need to be at to be able to get to 2% inflation. And unfortunately, the Fed is backing themselves into a corner. The Fed is saying we will not stop until we get to 2% inflation. This is very different from what they did in the 80s when they used the phrase opportunistic disinflation to say that, look, inflation's at 4 or 5%. Let's now wait, and we'll just wait until inflation gets to 2%. It ended up taking 15 more years to go from high inflation to 4.5% to 5% inflation, but then 15 years to go from that 4.5% level to 2%. 15 years. Today, the Fed is telling us, no, we are not going to resolve inflation that quickly, or we're not going to U-turn that quickly. We're not going to pause like that. We're going to go ahead and keep hiking until we actually get to 2% inflation. And this is now being priced into the market. And so if you're seeing red in the markets today, which you are, crypto's falling about 2%. That's even following the Binance hack yesterday of about $100 million. That was terrible. You've got treasury yields skyrocketing. Again, the 10-year sitting, knocking on the door of 3.9%, which is absolutely terrible for real estate. It'll create great opportunities for those investing in house hack, I believe. Accredited investors can learn more and read the solicitation over at househack.com. But let's actually talk about some of the numbers that came in here. We were expecting 255,000 jobs to be created. We actually got 263,000. That's above long-term trend, and it's hotter than expected. It's not hotter than expected by much. I mean, it's 8,000 more jobs, but still, it's not better than expected, right? So we didn't get good news on that. If anything, we got slightly bad news on that. We got slightly bad news in the fact that the labor force participation rate also fell. The labor force participation rate fell to 62.3%, down from the prior read of 62.4%. This has now helped contribute the headline unemployment rate to actually fall. The headline unemployment rate fell from 3.7% to 3.5%. And this is the last thing that we want to see right now, is the Wall Street Journal and the New York Times or whatever putting on their headlines, oh, look, the unemployment rate's going down. Economy's still strong. Economy's still really, really hot. Again, the largest job gains actually came from leisure and hospitality here. As much as it is true that I've been traveling and spending more on entertainment and food with family, I will say, I mentioned this in our live stream that we did earlier, I think for the last 6 weeks, I've probably had the equivalent of 4 drinks. Lauren and we just haven't been drinking at all. She also had a surgery that she had to go through, so couldn't. But anyway, been very interesting. It's really good for weight loss. Hint, hint. big 500-600 calorie Mai Tais are not very good for weight loss. But anyway, we had 5.2% of people teleworking. We had the labor force participation rate again at 62.3%. The biggest gains in workers again coming from leisure and hospitality at 63,000, with food service and drinking places rising 60,000, healthcare rising by 60,000, and professional business services rising by 46,000. Manufacturing 22,000, construction 19,000, wholesale trade 11,000, and financial activities and services down 8,000. I was mentioning that we'll probably see a lot more layoffs in the neighborhood of financial services, which could help bring down some of these strong jobs reports once you start getting companies like Credit Suisse laying people off and the other large banks, which are way too bloated with staff. It makes no sense that their earnings and revenue went down to the neighborhood in the neighborhood of 30 to 40%, but their staff and payroll bloated by another 10 to 15%. It's absolutely maddening. So unfortunately, this was not the best report, and it was certainly a hot report, which is now leading to expectations that the inflation report next week is also going to come in hot. I'll go ahead and give you the preview for inflation right now. This is before the jobs data came out. The expectation for year-over-year inflation is 8.1%, and the month-over-month inflation is expected to come in at 0.2% for the next meeting or the next CPI report. But unfortunately, with this jobs report, those numbers could come in worse than expected. You also had a revision up of the last jobs report, which was revised up 11,000 jobs. That's not great. So not only did you have a slightly hotter report, but you also had a revision up of the last report. Again, less labor force participation, lower headline jobs report or unemployment report. And then again, we have Wall Street now suggesting that we need to price in probably closer to a 5% terminal Fed funds rate. And so that's why we're seeing pain in the markets today, including the NASDAQ down nearly 2%, S&P 500 and Dow all turning red, Treasury yields again sitting about 3.9%, and the 5-year break-even actually ticking up as well. Even though the 5-year break-even is at the lowest point it's been in the last year, it's actually still at a high relative to 2018. It's basically at the highest point of 2018. And if you remember 2018, you remember that Jerome Powell was raising rates back then, and Donald Trump was threatening to fire Jerome Powell, something that hasn't really been done before and led a lot of questions like, can the president do that? But anyway, Jerome Powell was hiking rates back then when inflation break-evens were where they are now. So worth knowing, we definitely have some work to do, and that's why we're seeing red in the markets right now, so it's quite painful. Remember, if you do want to take advantage of that lifetime access to the programs on Building Your Wealth, take advantage of those down below. We've almost finished our Shopify store for this new product that we're launching, and then we're stripping lifetime access for some of the other programs, so make sure you check that out and lock that lifetime access in, link down below. I'm going to be heading over to a Course Member live stream probably in about the next 15 minutes, so I'd love to see you there. But we'll do some fundamental analysis together. But otherwise, this unemployment and jobs report, not so great, is a bad signal, unfortunately, for CPI going forward, and it's just not the best news that we were hoping for. Anyway, thanks so much for watching. Good luck out there as usual. Thank you so much. Thanks for subscribing, and we'll see you in the next one. If you need life insurance, remember, metkevin.com/life. Thanks so much. Bye.